Hey everybody, happy Halloween. How's everybody doing out there? Doc Severson with you here on October 31st, the last day of October, trade school here at Ready Set Crypto. How's everybody doing? Got a couple of folks on. Good to see you guys. Today I got a request to go over something, which is, let's go over here to trading the path of least resistance. And so what I'm going to do is I talked about this book that has been out there for almost 100 years now. So it's called Reminiscences of a Stock Operator. That's one of the tougher words to say in the English language. Reminiscences of a Stock Operator. I will call it probably the definitive trading book of all time. I can't think of one. So if anybody else has any other suggestions, I'd love to hear it, but this is by far the one that's remained the classic over the years, that regardless of the market that you trade. So this was very popular back in the days of, let's do this here. This is very popular back in the days of just the stock market. It was also popular for commodities, just about everybody that's traded anything. And of course, I think it also applies towards crypto as well too. Price is price. Right? Doesn't really matter where it's coming from. It's a supply-demand market. So this is what I have about Reminiscences. It's 99 cents on Kindle, so you can pick it up today if you want to on Kindle. You can search for the PDF that's out there, or what you can do is you can download the PDF and upload it to your Kindle for free if you want to. I believe it's past the statute of limitations, so it's probably in the public domain now. It's been out there for so long. Or if you just want to buy the book, you can find it used. Actually, buying a used copy is not a bad idea. Get the bigger print because you might be reading this thing for years and years, and you're going to kick yourself if you get the tiny little paperback. So get it in a decent form factor. You'll want to reread it several times on your journey as an investor. It came out in 1923 and has been republished many, many times. So you can imagine how things have changed over the years since 1923. So it speaks of this person named Larry Livingstone, which is kind of a pseudonym for the actual protagonist behind the book, which is Jesse Livermore. So you guys can Google Jesse Livermore, read up a little bit more about his life, and actually kind of a sad ending. And what's amazing about Jesse Livermore and is reflected in this book is about how he starts out in what are called bucket shops. So a bucket shop is almost like a little miniature version of a stock exchange. I don't know if there's any analogs I could use to explain what a bucket shop is in today's world. Not really. I mean, the problem is that stock exchanges, there were just a couple of them around, and it was very difficult to transact shares, right? So you'd have to get on somebody that would have to wire in an order to somebody, and it was just a very slow process. So bucket shops existed as sort of like a little miniature market. They're out there in some of the larger cities. So he would make a fortune in the little bucket shop, and then he would trade in the bigger markets. And he would get himself up to millions of dollars. And again, this is 100 years ago. It's a lot of money. And then he would find a way to lose it all. He was a very aggressive trader. And he would learn from that, and he would say, well, okay, I'll dust himself off and say, okay, I'm not going to do that again. And then go earn millions of dollars again using what he'd learned, and with a little bit more risk control to that. So his real claim to fame happened around the 1929 market crash, where he was short the market up to that point. And the bankers had to call him up personally and beg him to cover to release a little bit of liquidity so that somebody would take the other side of the buy offers. All right. So keep in mind that this book came out well before any actual charting or technical analysis studies were, were created. That's something down the wrong pipe. I mean, think about that. Technical analysis has only been something relatively new And I don't know when people started applying this, but people started probably actually charting back in the 30s and 40s, and that was all by hand, right? So there were no computer algorithms to actually spit out the charts. And so everything had to be done by hand. And that's why there was a lot of like point and figure charting and things like that, very obscure type of stuff back then. But, and especially indicators and studies and all these other magic things that we apply to our charts really have been a really relatively recent phenomenon. So think about somebody trading 100 years ago, and the only thing that they had was the ticker tape coming out of those, those bubble shelled machines that Edison invented, the ticker tape, so they would sit there and there was only just a handful of stocks back then, so they would just kind of rotate through and update the prices of those. And of course, they were all in eighths of a dollar. Remember that? Like 32 and 7/8. If anybody that's listening here has ever transacted in the stock market when it was still priced in non-decimal format, raise your hand. Moi, back in the 90s. It was kind of odd. I'm glad they decimalized everything. And now, I mean, to have something priced in eighths, you'd be able to, the high frequency traders to go nuts inside of there. So keep in mind, all of the stuff that we talk about today has nothing to do with chart studies or charting. It's all common sense for that. So here's some of the quotes. And again, one of our members, Tony, raised his hand and said, look, could you talk a little bit more about this concept of the path of least resistance? What does he mean by the path of least resistance? And so I dug into that particular chapter, and there's a few quotes that I pulled out of here. And this stuff is gold, guys. This stuff is really gold that he writes about. And to some degree, the things that he's written about, I've already forgotten about, but have been burned into my subconscious, that a lot of my actual trading and some of the guidance that I provide along here really came from the lessons that I learned from this book. So I'm going to read off a couple of these and just highlight a little bit of this. This matter of tape reading. So tape reading is somebody actually reading through the tape as it's coming out of the machine. Is not so complicated as it appears. The object of reading the tape is to ascertain first how and next when to trade. That is, whether it's wiser to buy than sell, or vice versa. You watch the market with one object to determine the direction, that is the price tendency. Now, I know that this is all obvious, right? This is all obvious statements here, but think about, again, the context of time, and think about how, when I read through this, what I want you to think about is how, regardless of the fact that we've had 100 years since the release of this book, roughly 100 years, that it's still, you can't determine what the future is. You still don't know what's going to happen tomorrow. So reading price, reading tape, reading a chart is still just as difficult now as it was 100 years ago, regardless of the fact that we've got hundreds of studies that we can apply to our chart. So it all comes down to the basics, which is what he's talking about here. For purposes of easy explanation, we will say that prices, like everything else, moves along the price or moves along the line of least resistance. And he equates it to water, like water will always flow downhill. It will always find that path of least resistance to work itself into and damage your house in ways that you can't imagine until you find them years later. So they will do whatever comes easiest. Therefore, they will go up if there is less resistance to an advance than to a decline, and vice versa. Okay, all very common sense stuff. But I think that we lose sight of that. We overcomplicate it. We depend too much on technology, and it takes away from our ability to make simple decisions. The simpler that we make this whole process, the better off that we're going to be. So nobody should be puzzled as to whether a market is a bull or a bear. And I think that's a great statement there. Nobody should be puzzled as to whether a market is a bull or a bear market after it starts. right? You should be able to look at any particular chart and say, is it trending higher or trending lower? And some of the things that we've talked about with the fractal class is that this is what the anchor chart is for. The anchor chart is there to show you which way things are generally moving. The anchor chart will show you where the trend is going. The trend is evident to a man. Now, this is written 100 years ago. This is before we had equality and all that stuff. So nobody please go ballistic on me here. I'm just quoting text. The trend is evident to a man who has an open mind and reasonably clear sight, for it is never wise for a speculator to fit his facts to his theories. Okay, understand what he's saying here. It is never wise for a speculator to fit his facts to his theories. What does that mean? Bias. That means that you've got a bias. You think you know what is going to happen. You have a theory behind it, and what you're going to do is you're going to selectively pick out facts to support your theory. This is called confirmation bias. This is what we all do. What we do is we search out for pundits that think the same way that we do. We search out for YouTubers that are supplying some type of analysis that think the same way that our theories go. So we follow the people that we want to agree with, or the people that agree with what we think. Confirmation bias. It's never wise to do that. You should always seek out opinions that differ from yours. The public is so often whipsawed that one marvels at their persistence in not learning their lessons. Well, okay, so the same thing was happening 100 years ago, wasn't it? The public gets whipsawed. Why? Because the public picks up on trading cues that have come way too late in the pattern to be acted upon. Public gets that information way at the end of they get whipsawed. You've heard that expression, buy the rumors, sell the news. There you go. So it was happening 100 years ago. So high frequency trading is not doing this to you. It's not some algorithm and programmatical trading that's doing it, that's making you lose trades. It was happening 100 years ago when things were not even electronic yet. Here's a really interesting one here. I mean, look at this is just in one chapter of this book. And I would challenge you to find anywhere else that contains this much wisdom, this much base fundamental wisdom about how markets operate than this one book. Prices are never, and this should be too high to buy or too low to sell. The price per se has nothing to do with establishing my line of least resistance. So when he's saying the price, I would say the value, the dollar or whatever currency that you're using, but he's not talking about the chart price. He's talking about the value of the price. This is where we get it into our heads of saying, oh, Amazon, it's $1,000 per share. Wow, well, that's way too high. That's way too high. Did you guys realize that it doubled in price in just a few months, up to 2,000? Right? So we assign our own judgment system, our own valuations on things based on what? Based on nothing. So this is something that's very interesting. And I would say, quite honestly, this is difficult to get past. This is really difficult to apply this in, because we all see things that are like, oh my gosh, look at that thing. It's just going berserk. That's way too high to buy. And then it continues going higher. So things are never too high to buy or too low to sell. Now, you never want to chase after something. So he's not saying to chase after prices with the rest of the investing public, because the public is going to be in too late. But really what he's saying is that, look, if you have something that it makes a new high, it pulls down, and then it breaks into new highs again, there's nothing wrong with taking that breakout at that price level, even if it is into all-time new highs. Okay. Next page here. The trend has been established before the news is published. And in bull markets, the bear items are ignored and bull news exaggerated and vice versa. Have you guys ever seen this before? Like, you'll see a market doing something like this. And I see this all the time, is like, it's going completely bonkers. And it can go the opposite way too, right? It's heading down. It's dropping like a stone. And all of a sudden, some good news will come out. Some good news. So the bull items will come out and the market just shrugs it off. And then the bear items are exaggerated. And the same thing happens on the way back up again too. In a narrow market, there's no sense in trying to anticipate where the price is going up or down. So what he's talking about here is when you get into a range-bound market like this. So clearly when the price is getting into a range-bound market like this and just kind of shuttling back and forth, everybody gets impatient. Everybody gets impatient. They want something to happen, don't they? Determine the limits of the range and make up your mind that you will not take a position until the price breaks through the limit in either direction. So is it going to go long? Is it going to go short? You don't know the answer to that. Now, Bolkowski might be able to give you a probability about which has a better direction to go. But why not wait? It doesn't pay to start wrong in anything. Okay, so I mean, I could go through the whole book and talk about lessons like this. So I mean, he does go over some of these again and again, you know, like talking about it's never too late to buy high within the context of how he's talking about it, right? So how can we apply these lessons with technical analysis? All right, so let's get out of the slides. Let's go over to the charts. Okay, so do you guys have any suggestions about what we could do? So we'll just bring up Bitcoin here. And a little bit of a pop today. We're still in the range. So if we're still in the range, he would tell us, don't trade while it's in the range. It's stuck in a range. Wait till it breaks out. Wait till it breaks out. So what are the things that we can do to apply today's technologies, today's techniques to some of his old recommendations? All right, so if we're looking at this, then clearly we can see that, guess what? There really is not that much of a trend right now. Actually, the trend is sideways. And if we go out to the weekly chart, we can see a little bit better that it's under a persistent downtrend, but we still have higher lows holding at this point. So it's in a range, and there's no point in trying to game this thing inside the range. But what we can do is we can add moving averages, can't we? We can add moving averages. All right, so let's reset this chart. And one of the ones that I like on, let's see, let's go out to the daily chart. One of the moving averages that I like, just as a general sense of trend, and we can just go out to here, and I believe it's under S, simple moving average. It might be moving average simple. Let's see if I can find it here. There we go. It's just moving average. So I'm just going to add this moving average to it, and I'm just going to format this guy. Let's make it big so we can see it. Let's make it super green so we can see this a little bit better. And let's go over to input, and we're going to change this to 200. So there we go. So this is about as simple as it gets in terms of determining the trend. So when you're doing something like this, so Jesse would say, well, it's quite clearly the uptrend is in play here. And if you understand market fractals, you understand that these are pullbacks in the major trend. These are just pullbacks in the major trend. The trend should not be that difficult for you to discern. And if you can't discern what the trend is, it's either for one of two reasons. Either you don't understand how higher highs and higher lows are moving up, right? Or perhaps the price is just in a range-bound condition, right? But this is where you have to understand that in this, this little downtrend that's occurring here is in the context of a larger time frame. So this little downtrend here, if I were to pull up a weekly chart, it would just show a weekly chart, just like pulling back like this with one or two big candles like that. So you have to understand the context of what's happening on your signal chart in the context of what's happening on the anchor chart. So the trend is quite clearly, if we use something like the 200-day moving average here, quite clearly moving up, and then eventually at some point stops moving up, flips around, and starts to go down. And then the moving average itself will tilt over and start applying as resistance. So right now we still have a longer time frame downtrend, which has actually gone quite flat lately. It's gone into just a flat market that's just not moving. This is range contraction. It's going to lead to range expansion fairly soon. Okay, so what are some other things that we can apply? So the trend, now we can add more than one moving average if you want to. You can have a moving average crossover to give you more of a signal. So you can add something like a 50 onto this, and you can have two different moving averages, and you can use those in conjunction with each other. But again, that's for folks that can't understand what's happening with the trend. So we can add another simple moving average. We'll just go down here to moving average, and we're going to format this guy. And again, a 50 is very commonly used with the 200 in conjunction with these guys. So let's make this a completely opposite color so we can see this. So this is a faster moving average. Faster moving average as long as we have the red line above the green line, then we have an uptrend, because the faster moving average is going to be tighter to the price. But when it starts to lose that one, then we have a warning here. And then once we finally have the death cross, then that's the end. Notice how long it takes. Notice how long it takes. For those of you that want to depend upon a moving average combination, it's going to take you quite a bit. But if you understand how price works, then you're out of this thing back here in the middle of January, right? Because you are coming down to a lower low, lower high. You have a downtrend on the daily chart, you're out. That's a weekly lower high and a lower low. You're gone. Okay, so now we have the red line under the green line. So we're going to watch for the next golden cross will occur when the red line crosses back up over the 200. And so that's going to be that upside cross for that. Okay, so moving averages, you can apply 1, you can apply 2, but understanding the trend should not be that difficult to figure out. And if you can't understand the trend, then zoom out. Zoom out to the next fractal. Understand what's happening at the weekly chart or an anchor chart time frame. Should always be able to understand that. The second thing that, well, let's see, we had a weekly chart here. Let's go to a daily. Let's go to a daily and go back here. So one of the concepts that he brought was, don't be afraid to buy into the all-time highs. So here we are, we're sitting at 3,000. The price goes through a nasty pullback. And how good is that going to feel for you to actually buy into the highs and buy and break out at 3,000? It's not going to feel very good, is it? You're going to say, but the price is getting weak. It's coming into a triangle. Oh no, it's like it might be starting to head lower. And it does head lower temporarily, and it throws everybody off. And then all of a sudden, boom, you've got a breakout through 3,000. And what happens to all of us is we tend to live our lives back here. We tend to live our lives back here. I mean, I've watched people for the last 10 years living through 2008, the financial crisis and the crash of 2008, looking behind themselves the entire time, thinking that every red candle that we have is going to be a repeat of that. So more money has been lost through the years by people being afraid of what could happen versus what actually does happen. This is why they always say, trade what you see, not what you think. So a lot of times we have this sort of like, it's called recency bias. So a move like this will make you very bearish, you know, make you like, oh no, it's going to be heading lower. And all of a sudden, boom, it heads higher. So everybody that went bearish down here is like scrambling to get out now. And so was that a good thing to buy in at the highs? Well, I would say probably it was, even though you did get a retest of this. So it's not necessarily, and so here we go again. So we've got up to 5,000. Was it a good thing to buy in at 5,000 at the all-time highs? Well, certainly it was, because it went berserk from there. And we could make the same statement about selling into the lows, but, you know, so even though it seems like, well, it can't go any lower than this, all of a sudden it does. Okay, a lot of compression down here. So that's the second thing. The third thing is just about buying breakouts, So a lot of times you'll see this, and actually some of the recent swing trades that we've been looking at lately have been better examples of breakouts, like Link, things like that. So Link's been in this sort of breakout mode, and we can start to identify these things. Look at that thing go. Right, we get into these modes where we just see chop like this. And you don't have to really think too hard. You just see a consolidation. If you have enough energy, then you're just buying the breakout. And you want to buy the breakout and sell it instead of selling the breakdown, because in this case you have an uptrend, right? So you're looking to buy the breakout for this one. So 3 very powerful concepts that were written about almost 100 years ago. So understand the trend at all times. Everything that you trade, you must understand what the trend is at the anchor chart and at the signal chart. And what's more powerful? Of course, the anchor chart trend is much more powerful. Understanding that buying all-time highs isn't as necessarily reckless as you might imagine. It seems reckless. It seems foolhardy to buy something that's already at the highs. We have programmed into us by Hollywood and by everybody else. Oh, you got to buy the dip. You got to buy the dip. But dips tend to lead to more dips unless you get lucky and catch the exact bottom of that. Again, there's no medal given out for getting the bottom tick of that correction. What is low can get much lower, as a lot of people have found out over the last 10 months. So buying the highs is actually not a bad thing to do because it's already got some trend to it, right? It's got trend, it's got momentum. Buying the highs. You won't want to do it. You'll think that you're surrendering. You'll think that you're chasing after something, but it's actually a fairly fundamental way to get long. When we do get a market that supports that. And then, again, the whole concept of just identifying the range, and then as long as it supports your longer time frame trend, especially the anchor chart swing, then buy the breakout of that. Now, the other thing I do mention in a couple of the classes, you can enter in the pattern if you want to. So that's one way to do it. Now, Jesse Livermore does not recommend buying something in the pattern because it can fall out of the pattern. That's certainly the case. But again, if you're fixing your risk on the position, if you're in a don't care mood on it, then I think that's still a viable technique, but it's not one that Livermore talked about. Okay, guys, that's really all I had to talk about for today's Trade School. I've got a topic for tomorrow, which is something that you probably might not have thought about before, but why does price move? Why does price move? We'll talk about that one tomorrow. Okay, let me know if there's any other questions. If there's any other questions for today's material, and none seen, so I'm going to sign off and see you guys. And don't forget tonight, tonight we have a ReadySetLive on at 8 o'clock Eastern, which is midnight UTC. 8 o'clock Eastern, midnight UTC. We're going to check in with Mav out in Las Vegas at World Crypto Con. All right, everybody. You guys have yourselves a great day. Hope everything's working out for you. And we'll see you tonight. You guys take care.
goes a sight from my soul. There goes a sight, there goes a sight. Now there goes a sight from my soul. There goes a sight from my soul.